Welcome back to another video, ladies and gentlemen. First things first, anything said in this video is strictly opinion content. I am not a licensed financial advisor. This most certainly is not financial advice. With that understood and out of the way, let's dive into will GME stock MOASS, and is it possible for this stock to MOASS? Now, first things first, I want to be perfectly clear. The mother of all short squeezes is what stands for MOASS, by the way. Those of you that don't know that, that is not my investment thesis. I am not in GameStop for a short squeeze. And I, quite frankly, think that the concept of MOASS is a similar concept actually to what short sellers are doing. And that is from Dr. Suzanne Trimbith. If you don't know who that is, she is the pioneer on failure to delivers, how they're being kicked around, and everything to do with those. Now, let's dive into this point. First things first, overarching topic. There is multiple things that would need to happen for GameStop to have the mother of all short squeezes. And now you might be saying, well, didn't 2021, January of 2021 happen, and that was kind of MOASS? It was a significant moment for the market, but because you had players like Robinhood who could have been working in tandem with a larger entity, which shall not be named. You can probably guess who. And let me know in the comments down below, too, what your opinion is. If you think MOASS is real, if that's why you're interested or invested in GameStop, let me know, too. But Robinhood obviously infamously shut off the buy button in January of 2021. And you could argue at that point, it was kind of DOA for a bigger squeeze. Now, if you go back to the chart and look, you'll see that GameStop, its share appreciation was significant, and it started long before. People associate this squeeze with just this quick period of time in January, right? This little blip here, and I say little kind of jokingly, but let's just say from $4-ish, from $5 all the way up to 120. That's split adjusted, so that's 2,243% in a very short, that's 23 calendar days. It's even less than that, really. So within a couple weeks span, right? Now, if you go back though and look at what happened before that, and you say, okay, well, GameStop was at $1 and then it was at 120. That's 10,000%. That's a massive, massive, massive squeeze. Now, we can go back and look at like the VW squeeze and this and that, and then what happened when Roaring Kitty came back in May of 2024 officially. He was back in late April though, and you got a 550% increase. Now, I'll tell you why I think that happened too, because that's a significant piece of the puzzle. And there's multiple things, I think, like a puzzle in this that would need to fit together rather perfectly, if you will, for MOASS to happen. No, I'm not saying it can't happen. Let me be clear about that. I do want to emphasize, though, that is not and has nothing to do with my investment thesis. So let's start out. We have a couple points here to make about all of the things that need to happen. The first and foremost is Regulation SHO. Reg SHO threshold list, when there is persistent failures to deliver on an equity, on a stock, to use more colloquial here. When there is persistent fails to deliver, you go on Reg SHO. Some people say it's meaningless, other people don't. It is a crucial part of a stock experiencing a potential short squeeze. And Regulation SHO is essentially a threshold list where publicly you can see with your own two eyes that a security is being persistently failed to deliver. So over and over and over again, someone is buying the security, but in the obligations warehouse, whoever's the one doing it, by the way, is not settling the trade. So you could sell a trade and it not be delivered. You could buy a trade and not be delivered. There's many mechanisms here, but Regulation SHO is a threshold list which shows the public, okay, we can say a million times over that the short interest on GameStop is much higher than 17%, what it's quoted at as of recording this video, right? We can say that till we're blue in the face. We can say that there's shenanigans going on with XRT, all that. But the underlying asset, in this case, GameStop, has to be on Regulation SHO. The fails to deliver must persist on the individual security. And let me show you what I mean by that. So when fails to deliver crop up on GameStop, it usually leads to some interesting price action. Now, we saw some big fails here with the bond offering. That's a more recent example. We saw some a little bit more consistently in late September, but really they can also be masked. So if you go over to XRT, which contains GameStop, the fails to deliver are simply outrageous. Now, I have some bigger, more consolidated fails to deliver sort of data from the point of which GameStop had its big squeeze, or it's, people can call it a small squeeze, big squeeze. It doesn't, let's not grovel over the details of 2,000 to 10,000% here. Okay. We're talking about a squeeze of some kind. But you can see the fails were significant on GameStop itself. So you had 40 million failed between July 1 of 2020 to December 31 of 2020. And, there's other factors like in that span, Ryan Cohen bopping in huge buy orders. We'll talk about that. Michael Burry's position earlier. We can talk about that. But besides the point, let's stick with fails to deliver. You can see they still persisted in large amounts through 2022. And that's when you can see their other tools really start to light up too with fails. So they've gotten a little bit better at kicking them through other ETFs. Now, again, let's not get bogged down by the details here, but you can see that leading up to December 31 of 2020, across GameStop itself, 40 million close to, IJH, VB, that's a Vanguard regular fund. You can see VXF, the Extended Market Fund. These are popular ETFs. XRT, obviously a huge culprit. You can see where they've shoved those two now. But that is a significant amount of fails. So you want to see GameStop go on Regulation SHO because there are settlement rules in place. Once you're on Regulation SHO, to get off, you have to deliver the security that has been failed. Now, is there nuances to Reg SHO, and can it actually be harmful for an equity? Sure. But in theory, let's stick with what we know. GameStop going on Reg SHO would be the best thing possible for the first sign of a potential short squeeze. You can see here that GameStop was on Regulation SHO, the threshold list, from December 8, 2020 to February 3, 2021. In that period of time was the best price action period on GameStop. Why? Ryan Cohen obviously pops in huge buy orders here. They fail to deliver the entire trade, obviously. Goes on Reg SHO, persistent fails to deliver. It's too much for them to handle. They can't pay out. Boom, bang, 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 bop. They have to settle it. Goes off Reg SHO in February. Stock comes plummeting down. It goes into a failure to deliver cycle over and over. And, I think, semantics here, but if they did not shut off the buy button on January 28th of 2021, it could have probably gotten a lot higher than what it did. I mean, it was a monster move to begin with. But either way, you can see GME was on Reg SHO in the best period possible with significant price improvement. Now, it has not been back on the Regulation SHO threshold since that point in time. If you asked me why, this is strictly my opinion. They've gotten more nuanced at kicking around FTDs. But point number one, overarching, if MOASS is possible, which I think, I'll give my opinion now. I think it is possible, but again, I want to make crystal clear, just because I think it's possible doesn't mean, one, I think it's it has nothing to do with, one, why I'm invested in GME, and then two, it actually might be catastrophic for the entire financial system, but that's neither here nor there. The second instance, which it makes it possible, but again, with a grain of salt, is a merger and forced closure of legacy fails to deliver. So it's kind of a theme from the first point, which was obviously significant fails in Reg SHO. Legacy fails. Now, if you go to, and this is for anyone that's more casual in investing, I'm going to try and speak in plain terms here, not because, I know everything. I don't. I have a very brief understanding of some of these rules and concepts. I want to make it easier to understand those. So the DTCC, in their rule book, they have, and I'll just show you guys, this is page 113, but this is from the National Securities Clearing Corporations. This is the official rules and procedures manual. This is available on the DTCC's website, and we'll go back to page 113. Now, how and what constitutes a fail to deliver? Well, that's where the rules are obfuscated. But if we go down here to section SEC 9, there is, and this CNS, by the way, stands for continuous net settlement. I even get triggered hearing that word, but essentially trades can kick around in CNS. Let's remove that for a second here and look at what designates a special trade. This is crucial to understanding a potential squeeze scenario and why I think When Roaring Kitty knew of this and ramped up the gamma with calls, it was partially because of this. A trade in a CNS security or balance order security may be designated a special trade. Special trade, isn't that convenient wording? In which case it will be cleared and settled on a member-to-member basis. Okay, so who's settling these? The parties to the special trade shall notify the corporation at the time and in manner specified in the procedures, and the corporation shall issue, receive, and deliver security orders in respect thereof, which orders shall be settled by the parties directly. So you're telling me that basically the rules are very hard to understand and that maybe members to members can clear their own fails between one another. Maybe. To the extent such as a special trade is for a security that is eligible for book entry transfer on the books of a qualified securities depository, and the deliverer has filed with the corporation a standing instruction, the corporation will issue an instruction on file to a qualified securities depository specifying the quantity of such security to be delivered from the deliverer to the receiver and the money settlement amount related thereto. The corporation may enter obligations arising from such special trades into the OW, the obligation warehouse service, in accordance with timeframes as determined by the corporation from time to time. You would need to be a high-level securities analyst to make sense of that obfuscated, super ambiguous rule. That being said, what the heck does that mean? Well, certain points in times, if you've got a bunch of special trades kicking around, that could be related to potential legacy fails to deliver. And you might be saying, well, fails to deliver have to be cleaned out and accounted for within 35 trading days or calendar days. Well, the premise of that is true on the surface level. Anyone telling you that that is true and by the book and that everything's cleaned up and tidy, I would be extremely, extremely wary of. Now, why did GameStop absolutely rip up? It wasn't because Roaring Kitty came back, made a bunch of memes and blah, 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 blah. He bought, now, tons of calls that were valued at $1.65 million, 120,000 plus calls on GME. But a special instance also happened at that same exact time, at same exact date. Schwab and TD Ameritrade merged in their business operations. Now, a broker merger like Schwab absorbing TD Ameritrade can result in operational processes that may force the closure of legacy fails to deliver, including those related to GME, but is not an automatic regulatory requirement. When client accounts and brokerage obligations transfer from one broker to another, the acquiring, which is Schwab, assumes responsibility for all outstanding obligations, including any fails on its books. So the entire lot of TD's fails, I believe, were closed out here in significant high volume environment. We're talking about 206 million shares, 187 million shares. Okay, this is significant failures to deliver being closed out. So if MOASS were to happen, if there were a significant squeeze, I think something along the lines of a merger between brokers would be in order for that to happen. Anything essentially where there is forced closure of positions. It doesn't have to be a merger. Take the Bank of Japan, for example, the Japanese carry trade. If the Bank of Japan raises their rates to a point where the borrower, let's say a hedge fund in the US, as an example, can no longer comfortably borrow to keep a stock suppressed or to keep piling money into short or synthetic short positions or swaps against, let's say, an underlying like GameStop in this position, if they can no longer do that, you could see maybe a similar effect. But for all intents and purposes, that is what I believe caused the rip in price, along with obviously Roaring Kitty creating a gamma ramp, it hitting gamma ramp, probably market makers having to hedge the options. You have a few things going on there, but I think above all, legacy fails being forced for closure is a significant, significant part of what happened there and would need to happen for GME to have a similar type event in the future. The other critical component to seeing an event like that would be someone popping in a massive, massive buy order that they simply cannot deliver. And it does go back to fails to deliver. I think that supersedes short interest. It supersedes anything. And if you've been paying attention to this video and you're still with me here, you'll know I haven't even mentioned short interest. It's because you see, and I'll just keep this again very plain as day, because of XRT, the number one way where shorts gain access to the underlying, in this case, GameStop, this thing has been a short percentage disaster machine for years and years and years. We have seen XRT short interest go up to 1,000%. Why? Because a mechanism called creation and redemption on an ETF, it lets authorized participants gain access to the underlying shares of, in this case, GameStop. So short percentage on GME is no longer what it used to be. Let's take a look at it. You're going to say 70 million shares short, that's nothing. Okay, that's fine. This does not mean that there's no short interest. It means that they have hidden it better through ETFs like XRT than they do on the actual underlying. Now, what would be super important for this to play out? You would want to see and need to see probably something like the Ryan Cohen significant buy orders that he bopped in late December, mid-December here of 2020, when he went from passive to activist in the company. You would need to see someone bopping in huge buy orders. It's too much. It's too much for them to deliver on. They failed to hold trade. GameStop proceeds to rip out on forced settlement. Same thing, if you saw Roaring Kitty come in here with massive options. And you know what's interesting about that too? Ryan Cohen's public filings and his December of 2020 buys. Well, that's public information. That's very helpful in this whole thing, because when you take a certain percent ownership in the company, you file the 13G. Roaring Kitty did not do that. He never crossed the threshold line, even with a 200 some million dollar position, very close to it though, at one point prior to dilution. But he got there almost and did YOLO update. So it was public. I think going public with that, if someone did stay below the ownership threshold for reporting reporting obligations, you would need to see someone go public, I think, with that information, because there's so much shenanigans with this particular stock. I mean, I'm sure it happened to other stocks too, but especially with GameStop, which I think is a large part of the entire market structure and the financial structure in the US. Now, a couple other things here I want to emphasize. Those, at that point in the video, those were the most important things possible. No ands, ifs, or buts about it for potential MOASS to happen. Do I think it could happen? Absolutely. Those things like the Japanese carry trade, for example, and in the Bank of Japan raising rates, that is very much on the table. It's really a waiting game. And if a borrower here is having trouble managing a position and the BOJ raises rates, even if it's 50 basis points, they can no longer afford to borrow. They might have to have a forced closure type event. I'm just saying, this is just total what if, but that could happen. It's not the strangest thing that would happen either. Now, I do want to call attention to this thread on Superstock. It's just a general post saying speculation, MOASS is real. They're saying clearly shorts haven't bought back the shares required to close their trade. Otherwise, the price would reflect a more natural fair valuation. Well, that's true. In theory, in the most basic, simple theory, that is true. Okay. But you've seen the company and GameStop do bond offerings, dilution events to ultimately increase the share count. Now, shares outstanding from the warrants as well is expected to go up, because I would wager that there is an institution that will likely exercise some of those, whether they need to or not. I would think they do need, but I believe that would increase the shares outstanding as well. You do not want to see these shares, if you're in the only MOASS camp, you do not want to see the share count continue to rise for GME, because that's going to water down a potential big order that someone bops in, creating this crescendo domino effect where GME ends up on Reg SHO and the rest is history, right? For me, MOASS has zilch, nada to do with my investment thesis in this company. I think this is a great American turnaround story where, yes, there is some T plus 33 type anomalies here. Look at the Bruno research paper of the FTD cycles on GameStop through various ETFs. I think it's all related. I think it's all linked. And I think Ryan Cohen personally has been shrewd and right and accurate in predicting this and taking money at 0% coupons for the company. Why? Because that raises the cash flow of the company. And yes, technically a liability on some of that. However, if he deploys that capital in a good manner where revenue increases for the company, then you're going to see big buy orders come in. You're going to see the narrative change on GameStop, and you're going to see, in my opinion, a more likely event, which is a Tesla type appreciation. We'll take a look at the chart. I'll show you exactly what I mean when I say Tesla. I'm talking about this, total shenanigans for a while. Look at this rounding bottom. You're looking from December 2016, to June of 2019, just shenanigans. Absolutely no price appreciation in the equity. Well, finally, Tesla starts delivering good numbers quarter after quarter. Shorts are like, wow, this thing ain't going nowhere. Then you see a 2,400% increase in the stock over, a period of time, of course, but slower, more methodical, and with some huge rips. I mean, this was crazy price action for the stock with significant volume. I mean, from 17 up to $65 is a big move. And you saw that multiple times. Comes back test, and then proceeds to rip up. So and this is funny numbers, from $23 where GameStop's trading close to as of this video, goes up to $300. That's a 1,100% increase on the stock. I think that's something that's more realistic. Now, I want to end this video with Dr. Trimbath's quote here. So if you're not familiar with her work, I highly recommend reading her literature and her opinion on fails to deliver. But Dr. Trimbath basically says this, paraphrasing: if your only reason for buying GME is to profit from MOASS, then how are you different from the naked short sellers who just want to drive the company into bankruptcy? If neither side are making a market for the security, how will price go up or down? I think that's a very interesting and unique perspective, because I'm sure there are people that, came back into GME when Roaring Kitty came triumphantly back and thought there's no way that Roaring Kitty was, coming back for basically a smallish, it was a big move, but a smallish move for the MOASS camp, right? If you think it's MOASS at 500%, I don't know if that constitutes as MOASS. I think that puts in perfect clarity what Dr. Trimbath said is, you need, the market needs to be made for GME. The reason why I'm invested in GME, and I have multiple videos kind of on this topic, but it's because this is an American turnaround story, and you're going to see a company report probably close to $1 billion of revenue in their next report because the business is a bit cyclical. But my thesis is, what happens when the business is no longer cyclical, but is a well-oiled machine quarter after quarter after quarter, in or out of a console cycle? And Ryan Cohen, who is a very good business person, has already had success with his Chewy endeavor, right? And e-commerce giant that it is, if he can take collectibles, pop up those numbers even further, take power packs, boost those even further, and then do a merger and acquisition sometime in the near future. How near are we talking? I don't know. I'm not Nostradamus here, but what if GameStop becomes a consistent billion plus, $2 billion plus a quarter business revenue wise? What's going to happen to shorts then? What's going to happen to legacy fails to deliver? It's going to be too much to handle. It's going to cause, in my opinion, a situation that is a more slow, extended type event of price appreciation and price discovery. I hope that helps. Putting a bow on it. Do I believe MOASS is real? Yes. Is it the reason why I'm invested in GME? Absolutely not. Is it going to happen? I can't tell you. This is not financial advice. I just wanted to lay out what I think would need to happen for it to then happen. Anyway, hope everybody's well. Let me know your opinion. Let's get some good discussion in the comments. Are you team MOASS? Do you even care? Is that why you're in GME? Or maybe you're even like, what is MOASS? What is this guy talking about? Either way, hope everyone is well. I will talk to you again real soon. Take care.